Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
Welcome out, everybody, to the Ty and Rye the Finance Guys podcast. With Ty Hansen. We already did that. That intro already was done. I don't need to do another intro.
Yeah. We need a different Ryan voice.
Yeah, Ty and Rye the Finance Guys, sponsored by
Nestle.
Sporks. Nobody yet.
We do need a sponsor. We need
Still looking for
sponsored by Be Kind to Everyone.
Yeah, that's a good one.
I love that group. They're awesome.
Tyler, are you doing good today?
I am. I'm really good. It's summertime. It's beautiful. I'm loving life. I'm ready to roll. Markets are rebounding this week, and the chaos of last week is kind of subsiding a little bit. So I'm good. I'm in good shape.
Yeah, and that's a great segue for today's subject.
It is, isn't it? I know how to segue.
Yeah. We're gonna really get into kind of some investing philosophies, kind of high level ways to think about the market, strategy, kind of what we like, kind of what you're gonna see when you're out there. And this is this is kind of a thing for you to think about individually as an investor, and also to think about it if you're working with an advisor.
Yeah, and I think what's good about this, and just to kind of reiterate why we are here, not from a religious standpoint, from like an actual business standpoint,
and overall,
why you and I are here.
Why are we here, and where are we?
Where
going?
did we come from? Where are we going? No, why you and I are here is to shine light on the financial world, so it hopefully makes more sense for our listeners, right? So it's like, oh, that's what's going on, right? And so I'm excited when you brought up this idea, we wanted to put this into this podcast. I was like, yeah, this is good, because I don't think people really understand how their portfolios are constructed, how their investment strategies are constructed. So this is good. I'm excited. I like it.
Yeah, and there's very practical reasons why they do what they do. There are market theories as to why they do what they do. And just as an individual investor, it's kind of good to have a handle on it.
Do you know what I will say? Do you know what it's like?
Ooh, gosh, another good analogy. Let's hear it.
I know, right? I am very analogous.
Mm-hmm.
It is like...
It's not like the Wild West, is it?
No, that's self-directed.
Weird to use that one.
It's like the running community.
Back to running.
Because I'm a runner. I don't know if you guys know this. So I run a lot of marathons, right? I love marathons. Love running. Done some ultra marathons that are over 26 miles. So
crazy.
In the running world, you can easily find good data and easily make arguments for dozens of different training styles, right? Like like the Hansen method is low mileage. There's, a lot of speed workout. Like there's all these ideas.
So your diet?
Yeah, diet, all these things, right? So there's a ton of different opinions, and to be frank, there's good in all of them. And there's some bad in all of them. But yeah, anyways, my point is, financial world's the exact same. You can find, for the philosophies we're going to talk about today, there's good data with both ends of the spectrum.
Yeah, right.
And so that's what I hope we accomplish today is it's like, okay, let's let you understand how they work, what the philosophies are, and maybe then in their individual portfolios, our listeners can say, okay, hey, I like this piece, I like that piece, and you know what I mean. That's my thought is you can kind of take the sum of the whole and make something better than just one specific one that's
Yeah, in my philosophy, and regimen for running is just don't do it. Just don't do it. Just stay away from it. It's the easiest method for sure.
You know what? The Ryan Robertson method actually is a good method. I like that.
Yeah.
I do.
Yeah. Take my advice. Don't do it.
I love it.
So with that, it's a good analogy, Ty, by the way. We're gonna talk about really sort of and thinking about investing philosophies and strategies on a spectrum, right? You're looking at it not as this black and white. It's either this or it's that. There's
Yeah,
different ways
exactly.
to approach it, and there's a spectrum for it.
Right.
So
Just like running.
exactly like running.
Okay.
I would make the analogy of diet too. The
Yes.
different
Oh, yeah.
ways of
No, that's
eating.
great.
Different people
Yes.
have different ways of eating.
Yep.
On the
and
one,
you know what? What?
no, it's like that's a terrible segue.
Okay. No, what I was going to say, though, you know what's interesting, though, is just like in dieting's better. I like your analogy better because the fad diets are what sell. Do you know what I mean?
Yeah.
Like, no food, just drink water. If you just drink water,
You only
you're going to
can
lose so
eat
much weight.
grass and leaves
Eat
from
grass,
your yard.
Grass and leaves from your dandelions are a must. Like those, it's a funny thing because that sells because it's like the get rich quick ideas or the
Yeah.
lose weight quick ideas. The same thing applies in the financial world too, right? It's like, again, nothing wrong with cryptos, but it's like crypto, that's the retirement plan of the future. It's
Yeah.
like, no, you just lost so much money the last couple of weeks. So
Yeah,
same thing.
you got to kind of have a pick a lane a teeny bit and stick with it for
Yeah.
a longer period of time because usually if
Yeah,
you get that
right?
yeah,
There is no investment philosophy that works
all the
in a
time.
very, 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 very short time and all the time.
Yeah, right.
Exactly.
So on the
Okay.
spectrum, we'll start at the most extreme ends. So on one end, however you want to look at
Just
the
like
one
you and I
end.
in running.
Exactly. On the one end,
The extreme ends of the spectrum.
you're on the extreme end.
Yes.
Would be something like day trading.
Yes.
Right.
I'm
so
a
day
trading.
trading, it's basically the idea that the market is inefficient and the price that you see
Yeah.
is not the price that it is, either up or
Yep.
down, and you can take advantage of that price. So, and it doesn't necessarily mean that
Yeah.
you're just selling the stock every day, but what it really means is that you're involved every day and you are buying and selling something
Right.
on a more daily basis. So, you can obviously imagine the work and effort that's going to go into being a more
Right.
active day trading investor.
Right.
And
And I think the idea there too is that there's ways or a black box. And I use black box because that's kind of a term in the financial industry, like your own like little special like algorithm.
Yeah.
That you can say, ooh, it's called arbitrage, right? It's actually this is cool. A quick little side note. In my master's, I there's a professor Dubill. He was at the University of Utah. Amazing guy, super smart. He actually worked on Wall Street, in the heydays before the crash of in '08, and he made a lot of money. And he would do future swaps. Not going to dive into the details of that because it's crazy complex.
It is.
But you could look at and currency swaps. So it's like you basically are like kind of guessing what the future price of certain currencies are going to be.
Yeah.
Anyways, and you could do these like 4 or 5 steps of what's called arbitrage, meaning if you can spot a difference in pricing where it's like, oh my gosh, I know like this price is a little bit lower than that one by like a few pennies,
Yeah.
you can make millions, if not billions of dollars if you're trading enough. And we would do these crazy intense calculations to figure out where the arbitrage was. Holy crap. It is the most intense, complex calculations that I've ever done in my life.
Yeah.
And that's the idea, I think, with this day trading is like, I have this calculation that lets me see that this stock or this option is going to be off by 5 cents. And if I invest and buy in today and then sell off at the end of the day, I'm going to, it's like,
Yeah.
it's crazy.
Yeah.
It's crazy.
And, just for anybody who's listening, this is kind of what you see when you see like training programs that get into it. And, back in
Yeah.
the day, it was the Thinkorswim group.
Yep.
And
Yep.
it was like red arrow, green arrow, green buy, red sell.
Yep.
And not that that doesn't have any value to it, but think of it in this way. I mean, this is kind of where this casino analogy is really applied.
Absolutely.
It doesn't really apply in some of the other ones we're talking about, but in this sense, it does. I always sort of think of it like, I played basketball in high school. I feel like I'm good at basketball. Not anymore, but when I was in shape,
I bet you're still pretty good with the ball.
I could play basketball.
You can take the rock to the hole.
But imagine if you show up to a pickup game and all of a sudden you've got NBA players there.
Oh, yeah.
So when you're jumping into this idea of whatever, day trading, whatever you want to
Yeah.
call it, where you're really actively trying to make money off of these minute movements. You're playing ball with some pretty big players.
And here's the thing too that I would also say. Now it's, again, we're not saying don't do it.
Right.
It's just understanding the Okay, so I have been in finance for a long time, studied it, right? I've seen a lot of really smart people. I've seen traders come and go. And one of the smartest human beings that I've talked to, like breaking down the way he calculated, he literally showed me everything with his calculations that he could, right? Literally everything. I saw the way he traded.
Jesus?
Smart guy. So smart.
You didn't hear me, did you?
What did you say?
I said, is it Jesus?
Is it Jesus? No, not Jesus.
Oh.
And he was doing really well, and he had a couple of months go sideways, and he lost so much money. And again, I really didn't ever put any clients' monies with him because I'm just like, this is way too risky, right?
Yeah.
But my point is, and he was a really smart guy, and that doesn't mean people can't make money doing this, but the point is it's hard. It is insanely hard to do. So.
And it's important to remember too, and this is kind of maybe getting too into the weeds, but there's a copycat process to that particular style.
Yeah.
Which means if one strategy works at a given time, because that's the inefficiency that they've pinpointed.
Yeah.
Other people are going to start to see it and adopt it, and then what happens? It becomes opposite.
Yeah.
If too many people are buying, that means you're going to be creating this bubble where at some point it's going to reverse. So there's this constant trying to figure it out.
And then they start selling banner ads on social media.
That's right. They're like, let's pass this off on to somebody else.
Just like a diet.
Just like a fad diet.
Just like a fad diet. It's like the dandelion and grass diet. Yeah. So that's one end of the spectrum. That's
a lot of training into that. Just keep that in mind.
Hey, that's just like me training for a marathon, right?
That's right.
A lot of time and effort goes into that.
You can't just show up to a marathon.
No.
And make it work.
No, you can. I've had a buddy do that. It was funny. Oh my gosh.
I bet. He was probably throwing up halfway through.
Yeah. He's an orthopedic surgeon now.
Yeah.
Okay. Wow. Other end of the spectrum.
Then you go complete opposite of that, which is now just complete passive, where, again, the philosophy behind it is can't time the market. There are no real inefficiencies in it. The price that the market is telling you is the price that everybody understands. So don't even try. You buy and you hold for a very long, long period of time.
Right. Exactly.
And, this is kind of related to, I don't know his name. Maybe we can't say his name.
I don't even know if we can say his name.
It's like the chef Gordan Ramsey says.
It's not Steve
Go
Ramsey.
strong.
It's not Chef
Be
Gordan
strong,
Ramsey. Go long. Yes. Gordon.
While he's filleting a steak.
Is it Gordon Ramsay?
That's what he says.
That's right. Gordon Ramsay's investment philosophies on Ty and Rye the Finance Guy.
Be strong,
go long. Get him
on
our show.
We should do a little cooking segment with him, and he'd say it 5 or 6 times.
Yeah. So that one guy named something like Gordon Ramsay, whatever his name is. Yeah, it's buy and hold.
That's right.
I would say too, there's another even maybe step further is a target date fund, which in fact a lot of our listeners may have target date funds.
Like a 401k type
in
strategy.
their 401k.
Yep.
And that's literally just like, I don't know what I want to pick, right? At my work, HR gave me this option, this list of 25, and there's like 10 of them say target date. Well, I know I'm retiring in 2055, so I'll just pick 2055 or 2050.
Yeah, exactly.
And that is so passive. It's literally like nobody's involved at all.
It's very robotic. It's just going to slowly transfer from stocks and equities into bonds as you get older.
Yep.
And you don't have to do anything. And again, as we've said, there's nothing wrong with that particular part. Like, even if you were just an individual investor and you were just going to be doing this on your own, you could buy a Vanguard fund that's based on the S&P and maybe a little bit in the ag, and you are good to go. And you just keep adding to it, and you never look at it.
I know, and that's the thing is like that's actually not a bad strategy. It's not like because everybody tries to accomplish this. I'm going to pick the perfect stock, like the day traders or the option, and you can get your ass handed to you. But if you do, I know, I did.
Hand it to you? Like actually taken off your body and hand it to you.
Gordon Ramsay hands it up and hands it to you.
It's like, I told you.
Because Gordon, all right.
Be strong, go long.
The Gordon Ramsay end of the spectrum's like, oh, don't do it. And then if you mess up, he's like, here's your ass. It's handed to you. I fried it up because I told you not to do it.
Don't worry, I put a little béarnaise sauce on it.
A little béarnaise, right. A little reduction. A little hollandaise reduction. Okay. So.
But that is very common, and it may be the most common one out there, particularly with investment advisors who are helping you. They're putting your money into a more passive situation.
Yeah,
and obviously,
like mutual funds too. Mutual funds are very similar to this.
Yeah, and the downside to that's important to understand is that it's not specifically tailored for you necessarily. And look, if you were retiring in 2008, you better hope that you were in something very defensive at the time.
Well, okay,
or Gordon Ramsay showing up at your door.
With your ass in his hand. You know what, though, I do want to talk about with that, if I may, for just a moment.
Please.
I really do want to put that disclaimer out there. Not disclaimer. Like, I'm going to jump on a soapbox for 1 minute.
Okay, 1 minute.
And
Go.
It's this idea that, don't get me wrong, a lot of people really got screwed over in 2008, and a lot of people didn't recover from it, and that sucks. It really does.
Yeah.
That's a big part of my why I do what I do. Is because I want to really kind of help people avoid that crap.
Right.
But here's the thing. If you are older, hell, even 55, 60, 65, if all of your money is still so subject to the market, and we're going to talk about this in a later podcast, like the 5 common mistakes that we see. What the heck? What are you doing? Like that's the whole thing is it's like if you're on the day trader end of the spectrum, or even too, I guess maybe if you're in the passive end of the spectrum, but you still have a lot of like passive, aggressive investments, like, man, come on. Like you just can't get greedy. You can't. And you can't make up for deficiencies in your retirement dollars all in 1 year, 2 year, 3 years. You just can't do it. You can't.
There it is. Yep.
And that's a huge mistake. So anyways, coming back to that point in 2008, I'm glad you bring that up. It's like, yeah, if you're passive, but you're aggressively passive, and you're sitting in the markets and something like which guess what? It could easily happen again. In fact, the way we are right now, more than ever, I think we're in a situation where we could have something similar to 2008 happen again.
Yeah.
So
don't be passive aggressive.
Yeah, passive aggressive. Oh, passive aggressive. That's perfect. Exactly. So, anyways, that's my soapbox: is don't be passive aggressive.
Yeah. Well, and it's subject to that roller coaster ride because if you're passive, you are accepting the ride up, you're also accepting that ride down with whatever you're doing, and you're not going to change strategy necessarily because the philosophy is you can't really predict any of that.
Yeah.
But you just got to be smart about how you're going to organize that over time.
Right.
Now, in the middle, we're talking more of, we call it active management.
Yeah.
Because it does have these elements of both sides of that spectrum. Where we do think there are times where we can take advantage of some of the different either inefficiencies of the market and or stronger sectors in the market. But at the same time, we don't necessarily sit here and think we believe we can time the top and the bottom of the market. And
nobody can.
Exactly the same time. We do not believe that. We're not day trading.
And that's exactly. And I will say that if anybody listening is listening, which a lot of times people listen to our podcast, listen to other podcasts, they're subscribed to other ideas. Look, if somebody says they have a surefire system, they're selling snake oil. Mm-hmm. They really are.
It's Gordan Ramsay.
It's Gordon.
No. Gordan Ramsay he's the one bringing you back to reality.
He is. They really are selling something because, again, so I've been doing this long enough now, been through enough marketcorrections.com, some of the gold rush, 2008, cryptos, meme stocks. Like I'm seeing this over and 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 over. Nobody knows. I will say that again. Nobody knows.
And
I consider myself,
and it is documented that.
Yeah. Oh, I remember having this argument in my undergraduate with some so I speak German. I was in these German classes, and I remember having this argument with What?
Guten Tag.
Guten Morgen. So I remember this kid having this argument that he's like, investing's stupid. There's no reason why you should invest. It's just gambling. Like it's dumb.
Yeah.
A monkey could do it better. And it's like technically, they've done that where like literally they'll throw darts at a board and monkeys have done better.
Yeah.
It's like, so now I will argue to the passive idea here is, guess what? Over time, you make money. You do. The markets make money over time.
Yeah.
But then on the other end of the spectrum, if you think you can time and know exactly when to get in or out, if you think unless you're Biff Tannon and you've got the sports almanac.
I like this one.
You can't, right? Now,
you've got the almanac.
That's fiction, right?
It
was Biff Tannon. I mean, it wasn't real, right? You can't. There is no almanac from the future that's going to tell us exactly what the markets are going to do. I would love to have that.
Oh, I know. I fantasize about that.
Oh my gosh, I know.
It is my number one fantasy.
When my wife asks me, like, so what are you thinking about right now? It's always like, I wish I knew what the stock market was going to do the next 3 weeks. I just wish I knew what the stock market. I wish I knew. Now you can't know. But here's the thing. I will say that there is a philosophy which we subscribe to, right? Full disclosure.
Yeah.
That market trends can be analyzed.
Right.
And market, current market conditions can be analyzed. And I actually, what I really like nowadays, in fact, you're kind of seeing this advent and the shifting away of just the mutual fund. And there's ETF strategies, and there's things where it's like there's more data readily available, and with that you can make more efficient decisions.
Yeah.
Right? And I'm a very big believer in that. And let me give you an example. Okay. So in 2018, my brother, we started working together, right? I managed some money for him. He's awesome. One of my best friends. He's been my best friend my whole life. We had a little discussion, a little friendly argument, if you will. Because again, he was a little bit more of the far end of the spectrum.
Did it involve Gordan Ramsey?
It involved Gordan Ramsey. Because Gordan Ramsey would say you've got to have the right smattering of all of the ingredients, right?
Yeah.
And my point was at that time, it was like, so basically in 2018, the foreign markets just did not do well, right? Domestic was a lot better. And I was like, he's like, well, I want to have so much percentage in foreign. I'm like, why? Well, this Gordon Ramsay guy says I have to. I'm like, why? Well, because I have diversification, bro. I'm like, okay, listen, here's the deal. I believe 100%. Again, I'm classically educated, right? University of Utah. Portfolio construction. I did it over and over and over and over for a lot of years and looked at a lot of theories and studied a lot of data. Yeah, diversification. We use that in our portfolios. We diversify.
Right.
But here's the point. You don't have to have again, if I went to my wife's got a very robust spice cabinet.
Ooh.
Right. In fact, I cooked dinner. I cooked dinner a couple nights. I'm getting to be a better cook. So I went to cook. If I took every spice out of that cabinet and mixed it all equal portions, so I'm equally using everything.
This analogy is fantastic.
Gordan Ramsay. It would be horrible. It would taste like crap.
Right.
It's the right smattering of the right ingredient. And so again, here's the point. So, the percentage of foreign position, his foreign allocation, it was extremely low, right? So the overall portfolio that I built for my brother did better. Now, I'm not saying that I'm a genius. It's like, look, I can look at data and tell you it's dog crap right now. We don't want it, right? Why do I want to do that? And that's the idea here. And again, so there's
but at some point, you should say, it will be.
Oh yeah. Oh, exactly. Okay. So let's actually bring something that's a little more current. What was one of the bigger holdings in our portfolio last year?
Gotta be the QQQ.
QQQ, which is tech, right? Very tech heavy.
Right.
QQQ is one of the best performing ETF, which again, an ETF is an exchange traded fund. It's like a mutual fund, but it's not. It actually trades on the stock exchange. There's not really a lot of cost to it. Very, 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 very efficient.
They did so well. They became the ETF sponsor for the NCAA.
Yeah, that's right.
Tournament.
That is true. And so
they are the ETF of the NCAA tournament. They did so well.
That's right. So we talk about banner ads, right? Mm-hmm. That's exactly right. So now this year is okay. So if I am asking you from a technical standpoint, is QQQ still the strongest piece in the market right now? What do you think, Ryan?
I'm going to say no, but man, it has moments. It is.
It does. I know it does have moments, but here's the thing: it's understanding and watching the trend. Yeah. Right now, this year is actually a little interesting, a little more interesting because we're seeing the market kind of oscillate back and forth between value and growth, and value and growth, and value and growth, right? Because of what's going on. But again, this is the idea. Why? It's just understanding why, and let's make better decisions based on the why. Why? Because there's this giant fear of inflation and interest rates, right? And so whenever that fear subsides, people are like, all right, let's make a lot of money in tech again. When that fear is there, people are like, I want to go to something that I trust. And so, but even that, even in the realm of growth and trying to be aggressive, you know what's been knocking the socks off of, beating the pants off of QQQ?
The JJJ?
The JJJ. The PPP.
I don't know.
Small caps. Small cap.
Oh, there you go.
Small cap. So smaller capitalized companies, smaller, again, doesn't matter if it's tech. So the point is this. I mean, we're talking about two isolated pieces here. When we look at the universe of what's available to us, there's this idea that you can rotate through areas that have more strength. Now, the idea there isn't that you can time it. It's just so 3 months ago, tech was still no. Let's look at this because again, we track this data. So last year, energy lost about 30%. Tech, QQQ made about 40 to 50%, right? The different tech side of the market. The last 3 months, the strongest performing market sector by a lot.
Yeah.
Energy.
Yeah.
Last year, it lost 30%. So again, last year, did we have any energy in our portfolio? No. This year, do we have energy? Yes, we do. Mm-hmm. So that's the idea is, and I think we're going to talk about this here in just a second as well. It's not only understanding where we're at in the markets, but it's then understanding, okay, at the global level, are there inflation right now, right? With this inflation scare, should we be heading for the hills and going to not necessarily cash, but going to defensive positions, or do we keep the pedal to the metal? Last year, COVID hits, right? COVID's hitting, markets are just falling apart. Top to bottom, peak to valley, it was down about 35%. Do you know what I mean? Do we stay or do we go? And that's the point is, again, you and I will never say, oh yeah, we know exactly when you get out. No, it's like, what is happening right now, and how do I need to adjust for that?
Yeah. Well, see, this is, again, you go back to this whole philosophy thing, the passive side of it is just never going to worry about any of that.
Yep.
So when you are in that strategy, you're not thinking in those terms really. You're just thinking in the broader market movements. And you're just saying, I am sticking in with it for the long term. It's going to go up, it's going to go down, and overall it's going to be better down the road. In our philosophy and how we look at it, we want to be able to take out of things that we think are going to perform more, or we're going to see loss. So we are making some judgments about what we're seeing in these movements, the volatility, right? These moving averages give us a sense, hey, this is kind of weak. This one's kind of strong. Let's move that. But see, even better than that, we can come back to that tomorrow, next week, next month, and say, hey, this one's picking up. This one's getting better. This one's showing some weakness. Let's move back. So I think
and
go
ahead.
No, you go.
Well, no. You're hitting the right point. That you're making the right point. There is that this is what this philosophy really boils down to: is information's available, and the market is constantly changing. Right. So why? And again, the whole point of this whole podcast is for us to be kind of cutting through the noise and understanding what's really going on. We want to explain that to people. And so ask yourself that question, right? Are my money's just more passive? Am I kind of at the whims of the market, or am I a day trader, right? and or ask your advisor, right? Like understand how you are invested, right? Because there's, I don't know. I would just say that, like, if you're older and you're doing nothing but being passive, and you're a little bit more on the aggressive end, if you're passive aggressive, right? You're doing yourself a disservice.
Yeah, you are.
Right? And so that's the whole point of this, is just understanding and being more in tune with and understanding what's going on in our own portfolios. That's what's important about this.
Yes. And having that sense of it too, just you can ask the right questions about it.
Yes, ask the right questions.
Because again, if you're in an active management style investment, you might be able to feel comfortable being a little bit more aggressive. Because
absolutely.
And that will change if we need to. So that's really important to understand, because otherwise you are just changing your diet, eating habits, trying to follow one, trying to do another. You got to find and stick with something that works really well for you, and you'll be better off.
I agree. Otherwise, otherwise you lose 20 pounds and then you crash and you sit and eat an entire cake by yourself.
Man, that diet analogy is really working out now.
I know, so good. Gordan Ramsey cooking. I think we both must be hungry today.
So if you don't want Gordan Ramsey showing up at your house, you need to know the strategy that you're doing and be prepared for that strategy. Otherwise, you're going to get a knock at your door.
And your ass is going to be handed to you. Exactly.
And you don't want this happening when you're 68.
Exactly.
Yeah.
Be proactive with your portfolio. Ask yourself, what is the philosophy of my portfolio, and actually break it down and look at it. Right. Yeah. Take the time and think about that. So
that's right. Yep. And work with whoever you're working with. If it's us or somebody else, make sure that they've got a good understanding of what they're doing with you as well. I think sometimes it does happen where you just feel like, oh, they're my advisor, I'll just do whatever they say. And sometimes that's fine if they're good at it, but other times, take some responsibility and just be involved with it.
I will say this too. We one of our business partners we do a lot of work with, Mike Minnick. We looked at some research on different actively traded mutual funds and active traded accounts, and it was interesting because you can do a study with how it follows not follow market returns, but how it follows market volatility. Right? If volatility hits and a portfolio loses over time, a quote unquote active portfolio, how close does it follow that trend, right? Or does it move different from the average trends, right?
Yeah.
And it's really interesting, even quote unquote active portfolios, how little deviation they have from just you know what I mean. So that's another thing to be cautious of and cognizant of too. So philosophies, right?
That's good.
Are we day traders? Are we trying to be crazy and run marathons every couple of months, or are we passive? Are we sitting on the couch? Right?
I know what I am. I know what I am.
You are a pickup ball wizard. You are taking those kids to school all the time.
As long as they're in middle school, I can handle them.
That's right.
All right. Well, you got anything else you want to? Any other parts of wisdom that you want to give everybody?
No, I think we're good. I think
you want to. Yeah, that's right. Save some for the future. Don't.
That's right.
Don't
I know.
throw
Leave them
out
wanting
now.
more. No, active, passive. I like it. I think we hit it.
Yeah.
Got it. We're good.
Yeah, everybody. myprosperteam.com. You can go there, see all of our links
and
to subscribe.
Coming soon. The tyandry.com, tyandry.com, tyandry.com. That's coming too.
It's not Tiandry. It's not Tiandry. It's Ty and Rye.
Tiandry.
That's what it means. But all of it's on there. You can go to You can go to Apple, Spotify, subscribe, give us comments.
Yep.
YouTube. We get a lot of people that like to watch us.
I don't know why.
I don't know why either.
We're radio pretty.
I
don't know if we're TV pretty.
So,
you're TV pretty, Ryan.
But we appreciate anybody who listens. Go there and subscribe. Let us know what you think. We'll try to figure it out. Ty, I appreciate your time today. Be kind to everyone.
You too. All right.
See you, man.
Thanks, buddy.
See ya. Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.